Can you share my, oh, does it work? Great.
Yeah, can you hear me?
Yep, can hear you.
All right, perfect. So thanks again, Evgeny, for terrific lineup. It's great to be part of it. And it's great to discuss this particular paper, also given that I know the authors quite well. So, so Thomas gave a very intuitive description of the paper, which to some extent I don't think does justice to the model, because the model is really nice. It's a very, so for someone like myself who's interested in this, like the theory side of this questions around the value of cryptocurrencies and then consensus protocols, the part which is really fun is that this is a model that combines many of the, I would say, most interesting contributions that have been made in the recent years, but just put them together. And I think when you do this, you get interesting interactions, which is, I guess, at the end of the day, why this paper is so interesting. So just to give a quick overview of these different ingredients and how they interact with each other. So the first ingredient in this model is it's an OLG model. And that's interesting because what it gives you is a fundamental value for cryptocurrency. At the end of the day, cryptocurrency is a currency. So if you want a fundamental value, a meaningful price for it, you need to have in your model something that makes it valuable. And here it's going to be that, when you're young, you have those consumptions good, but you also care about consuming later on. And so you need some way to store value. And so these young users, they're going to have two options, so some kind of standard assets, which is imperfect in the sense that if you buy for 1 unit of consumption goods of this standard asset today, you're only going to get sigma lower than 1 tomorrow. But you can think of this as being kind of your upside option. And the alternative is to buy a crypto asset also as a way to move consumption over time. Okay, so you can also invest one here. So first of all, who do you buy from? So that's the OLG side of the model. You're going to buy from users who are old now, who bought those assets before, and now they want to consume. So they're going to sell those assets to you, plus maybe some other players like miners. And then, so this is a part of the model which is interesting. So what you get tomorrow when you sell these assets is a bit more complex than for the outside option. So forget about pi for the moment. You get a first component, which is to some extent the equivalent of sigma here, right? So this is basically, the value of this asset may be diminished by some kind of inflation because maybe there's been some creation of new crypto between the moment when you bought and then the moment when you sold those assets. Okay, and then there's a second part here, which is related to the fact that there's a time friction when you buy an asset. So it's going to take time for this transaction to be processed, and that creates a disutility, which is here. Okay, so there's different users have the different disutilities from waiting. The important part here is that waiting, of course, this depends on, so the amount of time you have to wait depends on some underlying deep parameter technology parameter, but it's also an endogenous object. It depends on the fees that you're going to set, that you're going to pay to miners in order to gain time priority. And so that's the second kind of block, which the authors embed in this model. And that's basically is very similar to this congestion pricing paper by Huberman and co-authors in Ristad. An interesting insight from this paper is that, so this mechanism is efficient in the sense that it's going to allocate time priority efficiently. So those who have the highest cost of waiting are going to get faster execution. But of course, what this paper cannot really say is to what extent the fees that are collected by the validators in the process, to what extent the level of these fees is efficient. And that's one question that this model is going to be able to answer. So because you have this congestion pricing, so validators, there could be miners, it could be stakers, that's going to depend on the consensus protocol. They're going to receive some of this. So they're going to collect the fees that these users have to pay. And then they're going to have some influence, at least in the proof of work case, they're going to have an influence on the final parameter here, which is pi. So that's the security of the network, right? So you get one, but then, so you invest one, but you're going to get this only with some parity pi, which can sometimes be smaller than one, okay? The last bit, which is not even here on my slide, is that inside this box, there's also a whole machinery that builds on existing work by Fahad and others. So also this validating process is endogenous. And the extent to which security, the way security is going to be set is also endogenous. So it's really like a nice way to assemble many different things. So intuitions. So what happens if I increase the transaction rates? Okay, so this waiting time is gonna go down. If I'm in a proof of work consensus protocol, so let's say without block rewards to simplify, the fact that waiting time goes down means that the fees are going to go down, because for now my willingness to pay for time priority is lower because the value of jumping the queue is not that high. So the problem is that this is going to lower the revenues of the validators, so the miners in this case. And so the hash rate is also going to go down. So the incentive to expand computational resources is not that high, is because the reward in case of being able to add a block on the chain is not that high. And that's a problem essentially, which is that it's going to feed back into the security, right? So if the hash rate goes down, it's easier for an attacker to overpower the miners. And so here, the probability that there is no attack is going to go down. And that, of course, can feed back also into demand, etc. So that's basically the intuition for why if you increase the transaction rate, sometimes it can be bad under proof of work. And at proof of stake, so the beginning is exactly the same. So you increase transaction rates, you lower this waiting times, that's going to lower the validator revenue. But essentially what you're doing is you're cutting down that channel. So there is no feedback from validator revenues to pi, okay? Instead, what's going to happen is that, so validators capture less, also the waiting time is lower, so that's going to boost demand. And when demand increases, the price increases. And when the price increases, the security goes up because now it becomes more difficult for an attacker to buy. It's more expensive to buy a majority of the tokens. Okay, so that's kind of a quick intuition. So few comments. So just in terms of broad context, I think one, to some extent, this is a paper that challenges my preconceptions on the pros and cons of proof of work versus proof of stake. So my view was initially, at least, that the selling point of proof of work is that it's robust, right? It's a very robust implementation of a random draw. It's hard to manipulate, except the only way you can do it is by overpowering the existing miners, which is difficult to do if you have a large a blockchain with a lot of users and a relatively high value. And there's a proven track record of a betting attack for this large open proof of work blockchains, okay? So to some extent, and of course, proof of stake is the solution which is on paper more efficient, but this robust implementation has proved challenging. Okay, let's put it this way. So in my view, at least initially, my view was, it seems like proof of work is the one which is more robust, more secure. Proof of stake is the one for which we have maybe more question marks. So to some extent, I think the one value of this paper is to say, okay, maybe this is not as simple. There are other things you should take into account. One thing maybe to look at is, so we've had some kind of an experiment along the lines of this paper. So we've seen an increase in the transaction rates on Bitcoin in 2017. When the block size essentially was increased. So if we think along the line of this paper, this should have an impact on security. So was it the case or not? I'm not sure, but at least there's one data point maybe we could look at. If I look more like specifically at the results of the paper, so one question I have is, so most of the results are this kind of threshold type. So essentially, if you look at the proposition, it's going to be So if transaction rate is above a certain level, it's either fully unsecure if you're proof of work or fully secure if you're proof of stake. Which of course leaves open the question of what exactly happens below those thresholds, okay? So for instance, is it the case that security increases, decreases monotonically with this transaction rate, even beyond zero, outside of the 0 or 1 bound? It seems like in the case of proof of stake, that's the case, in which case it seems to me you could fully characterize how security changes when the transaction rate varies, not just at the limit or below a threshold, but for any value. The proof of work case seems a bit more like I don't really have very good intuition for that, right? Because it seems like there you could have countervailing effects, right? So in particular, one thing that's going to happen when the waiting time goes down is that demand should be higher, right? Everything else equal. And then you could see this feeding back into the revenue for the miners being higher, okay? In particular, if they have block rewards. So I think the intuition for what happens in that proof of work is not completely straightforward. A related question is, it could be the case maybe that in some regions, proof of work is more secure than proof of stake. We know it's not the case when lambda is very high, but what if when lambda is very low? This could maybe give you some explanations for, why is it that proof of work historically developed before proof of stake? And beyond this, there's, it's a model which has qualitative predictions. But so we don't know exactly what's a relevant range for lambda in practice, right? So should we really care about being above these thresholds or not? Is it something which we're going to reach at some point? That's hard to know. If you give a more complete characterization, maybe we can be a bit more confident about how these things are going to move through time. The second thing I'm going to highlight is the intuition on block rewards. Because there, I don't think I have a very good intuition. I see the results, but I'm not sure I really get the economic intuition. So the result in the paper is that, even with block rewards, if you push the transaction rate very high, proof of work blockchain becomes fully insecure. And intuition that actually Thomas gave in his presentation is that, block rewards is essentially a tax on users. And so you cannot increase it too much, otherwise basically users are not going to adopt. But still it's not intuitively, so there's a bound, I understand this. What's not clear to me is why this bound is so low in some sense that it prevents you from achieving security on the proof of work blockchain. So that's the part which I don't really think I have a very good intuition for it. It seems to me this is related to some of the distributional assumptions, for instance, in the model. Also, in reality, we know that block rewards are relatively small on Bitcoin. If you relative to total floats, fees have been small, so we're actually relatively close to what the model looks like when lambda is really high, and security seems okay. So I'm not sure exactly how to think about this. I've been too slow, so I'm running out of time. So let me just throw one last idea there. It seems like one thing your model could generate is these feedback loops, a little bit like what happens in Emiliano's paper, right? So you have this dynamic where if you have higher security on the proof of work, you have higher demand, higher price, potentially higher hash rate through the block reward, and in the end, higher security. And so that happens in Pagnota. It seems it could also happen in your model. But also interestingly, one thing that Pagnota doesn't have is that it doesn't look at proof of stake. And it seems that it could happen, that you have higher security, then higher demand, higher price, which then gives you higher security. And then that potentially gives you all sorts of interesting things, like you could have equilibrium multiplicity. I'm not sure if you have this, to what extent also this is something you could talk about, but also this network effect, if you think about competition between proof of work and proof of stake, it seems like there you could have this, winner take all kind of effects, which maybe are interesting to look at. Apologies for going a bit over time, but let me just.
No, you're right on time.
Okay, so let me just leave you with the slides, but again, great paper.
Thank you, Matthieu. So Thomas, we have just a couple of minutes, but you get a chance to respond. And there are also some really good, two good questions there in the chat that I was also curious about myself. If you have time, if not, you can also type in your answer. Go ahead.
All right. Yeah. Thank you so much, Matthieu, for that great discussion. So there's a lot of questions there. One thing, so looking at this example you gave about the scale increasing, right now, so this model I just wanted to clarify is a steady state. So we're studying steady state equilibrium. So we're really thinking about a long-term vision for blockchain. So this relates to what we observe right now, maybe also to Gustavo's point, which is like at this current stage, there could be other incentives driving mining activity, for example, price appreciation and things like that. So this is something we sort of abstract from in this paper when we study the steady state, because our miners are really, they're just earning the block rewards and the fees, and they're not expecting those earnings to appreciate in any meaningful way. This also relates to your last comment on this feedback effect, which I also think is interesting. That you could model in a steady state. It's just the question is, as soon as, where is the upper bound on how high demand can grow, right? So realistically, you can't have more demand than there is, users in the economy. So there will be some bound at which this feedback loop stops. And I think kind of the relevant point would be where exactly are we, what is the total, let's say, capacity for cryptocurrency adoption? And this all sounds like very interesting work. We'll see. We'll think about including in this paper, but maybe also in a future paper. Regarding Jason's question, I just wanted to say, right. So I think what you're alluding to is possibly what about the fixed cost of entering the mining, entering as a miner, the mining market. So I don't see why this should really change our results. Maybe I think you're thinking it would get cheaper to enter in that case. I know there's some related literature. Maybe I can send you on fixed costs in mining markets, but I think for the most part, our results would be okay with this. I'm sorry if I'm not giving a clear answer right now. I'm just